Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 36.76%. Its performance actually went up this week, even though the S&P 500 fell, and it's beating the S&P 500 since the portfolio started. And our dividend growth stock portfolio also saw its return increase, as it now has an annual return of 19.91%. It too is beating the S&P 500. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,233.83 after 134 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting 2.5 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings and investing goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the markets did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,233. The portfolio's return has been 19.9% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and in the preceding year, the portfolio also beat the market. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 36.76%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 21.92% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. Of course, the mega cap tech stock pullback this week and last week definitely helped our high yield stock portfolio. Now remember, the high yield portfolio has only existed for 12 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio, as we definitely saw this week with another large jump in its total return. This slide shows the growth of the dividends we received in our dividend growth stock portfolio. The graph shows the cumulative dividends we've received so far. Our dividends this last quarter increased 51% over the previous quarter, and our dividends in June increased 87% over last month's dividends. So why do we only invest in dividend-paying stocks in both portfolios? The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I printed at the bottom of this slide. Morningstar also recently released a report that went back all the way back to 1927, so a much longer study, and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios only invest in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, it also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first is Broadcom, one of my favorite stocks. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield, based on my original investment, is now 8.13%, and that's just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you are married and filing jointly, you can make up to $123,250 in qualified dividend income and pay 0 federal taxes on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. These amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends than the previous year. Then the final step is take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. So the main reason why we invest only $12.50 $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account now, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation every year. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For our classroom stock portfolio, for the Dividend-Growth portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week because inflation was higher that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker SCHD. Now, SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's annual return is 19.91%. If we had invested instead the same exact amounts into SCHD on the same days, the portfolio's return would only be 11.11%, a difference of 8.8% per year. Our high yield portfolio is also outperforming SCHD, as you could imagine. Obviously, there's no guarantee that our portfolios will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategies rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions of stocks that I consider to be value traps, and those are not a good thing. This slide shows our best performing stocks in our Dividend-Growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, moves to this top spot in the last couple of weeks with a total return of 207% in less than 2 years. A 207% return means that it has more than tripled. As you will see when we get to our slide on dividend increases, our investment banks have been doing great. Stocks in yellow have been sold. We recently sold Bank of America for a 62.7% return in 15 months. Bank also recently increased its dividend 8.3%, so that's good news for those of you that own the stock. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% or so of our investments made in this portfolio were made to these stocks, which means they are high-quality stocks with a great track record of increasing the dividend payouts to investors. The other 10% or so of our investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they have historically beat the market averages by a significant amount. And of course, because they're smaller, they're also more volatile. This slide shows our best performing stocks this week. Despite the market pulling back again this week and large cap tech stocks like Tesla and Nvidia getting hit pretty hard, we had a slew of good performers this week, led by Bristol Myers with an 18.2% gain, Thermo Fisher with a 13.6% gain, and Lockheed Martin and Allegiant also posting double-digit increases this week. Here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now, let's talk about the stocks we sold this week. We don't sell stocks often, but this week we sold 2 because better opportunities became apparent. First, we sold Amgen, a biotech company, for a total return of 67.4%. Oops, make that 47.4%. And it was sold from our high yield portfolio because it appears to be fairly valued. We also sold Core Labs for a return of 37.8% in about 6 months, which is an annualized return of 89.7%. Core Labs was sold from our portfolio that specializes in companies with strong competitive advantages. The average purchase in the portfolio has resulted in an annual return of 24.6%, which is beating the ETF that specializes in companies with strong competitive advantages. That ETF ticker symbol is MOAT, M-O-A-T. We don't talk about that portfolio a lot because the one I'm investing in myself are the dividend portfolios, but if you want to know more about that, we can always talk about that. Now let's talk about the dividend growth stocks we bought this week. Here are my ratings for the top 12 dividend-paying stocks this past week. Now, new to the portfolio is Raymond James Financial, which is in the investment banking and brokerage sub-industry. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be W.R. Berkley, Comcast, Nike, and Papa John's. Remember, all these stocks pay a dividend and have recently increased their dividends, and their methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields are, in order, Interpublic, Papa John's, PNC Financial, and Comcast. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. As mentioned earlier, the other 10% or so of our investments are invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Now, if you're looking for lower risk stocks, I would just suggest starting your research with Nike. Next would be Thermo Fisher, Visa, and MasterCard due to their A+ financial grade to go along with average risk ratings. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings this week are Thermo Fisher, MasterCard, and Visa. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Comcast, Nike, Raymond James, Interpublic, and PNC Financial. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are W.R. Berkley, Thermo Fisher, and MasterCard. The companies with the best combination of recent dividend increases and potential of future dividend increases are W.R. Berkley, Thermo Fisher, Comcast, Visa, MasterCard, and Raymond James. On this slide, we're looking at stocks in our portfolio that have raised their dividends recently. The holy grail of investing, as we said before, the holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6%, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. The last 17 dividend increases for our dividend growth portfolio have an average of 17.1%. This slide shows stocks in our portfolio that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we've received once a stock split has occurred. Here's a look at the top 10 stocks that make up the largest portion of the dividend growth portfolio as of Sunday. After seeing its price jump 10.2% this week, Allegiant has moved to the top, followed by Comcast, then American Express. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 96. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet from our multiple sources, which we do at least weekly and doesn't take that much time. Now, I've had several older students who are closer to retirement take my classes, and they are more interested in stocks with higher dividend yields, and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So, in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annualized total return of 36.76%. Since the portfolio has been in existence for a few days short of a year, that return will likely fluctuate a lot. Currently, the portfolio's dividend yield is 4.25%, but the companies in it likely won't grow their dividends as much as the stocks in their dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends already, pushing the portfolio's yield based on the amount that we have invested to 4.98%. Now, two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth, and so far has been the better performer. The average investment in this strategy has provided a total return of 16.31% and has been held for an average of 158 days so far, which is an annualized return of 41.6% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annualized return that high since stocks historically average about 9 to 10% each year. On this slide, we're looking at the high yield dividend paying stocks we bought this week. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchased 8 stocks, and we have 2 different strategies within this portfolio, as mentioned before. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 also emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2, as you can see with Interpublic at the very least this week. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8 of a weighting, which is 1/4, equivalent to 25% of that week's investments. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing strategy 1 are Devon Energy, Interpublic, PNC Financial, and Darden Restaurants. And the 4 high yield stocks we bought this week while implementing strategy 2 are Interpublic, Papa John's, PNC Financial, and Chevron. This week's purchases have an average yield of 4.3%, with Devon Energy coming in the highest at 5.8%. And here is a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which, as we mentioned earlier, will be much lower than for the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So that's it for this week. Let me know if you want to see videos about any other investment topics. You can get a hold of me on X or Twitter, LinkedIn, my website, beatthestockmarket.com, and of course, here on YouTube. Have a great week, and we'll talk to you next week.